Hi, good evening, all of you. Yeah, in fact, good evening, good morning, and good afternoon to all of you. Welcome to the fourth mentorship session of CMT Association's Investment Challenge 2023 August edition. And thank you so much, Dave and Kavita, for joining us and sharing your invaluable insights as always. And we have Siddharth and Sharvari, our last week's winners. So let me just quickly ask Kavita and Dave to introduce themselves to all our new participants of Investment Challenge, and followed by Siddharth and Sharvari. After that, let the conversation flow with whatever question you have for our mentors. So over to you.
All right, Dave, you want to go first?
Oh, doesn't matter to me. If you want to go first, you can. I'll go first.
Right. So hello, everybody. This is Kavita Agrawal. Oh, okay, sure. I think
that's okay. I'll go first. Okay. I'm sorry to interrupt, by the way. So hello, my name's Dave Tonaszuck, and I am from Boston, Massachusetts, in the United States. And my experience in technical analysis is that I became a CMT back in 2000. Well, I started studying for it in 2007, and I think I got it around 2009, maybe, or 2008. I can't remember. But I've been working in the field since then, so 16 years, and I not only have my CMT, but I have my MFTA, which is part of the International Federation of Technical Analysts. And it's what it is. It's you basically write it's like a college level study. You write a thesis, you defend the thesis, and they grant you what they call a Master's in Financial Technical Analysis, MFTA. And so my work experience, I've worked for a broker-dealer in Boston, Mass, for about 11 years as their lead market technician. And what I did there is I built stock trading models, but we basically used ETFs. And I built the models, built portfolios, managed portfolios, and helped financial advisors not only learn technical analysis, but able to speak to it to their clients. Since then, I left there in 2018, and I still work with financial advisors. I help them kind of do the same thing. I help them understand the markets from a technical analysis perspective. I also still run my models, and my models are basically relative strength models. So they're what I would consider sector rotation models based on the S&P 500 index. So what I would do is I'll do relative strength analysis of the sectors in the S&P 500, and whichever ones are trending based on the algorithms I build, each month I reinvest the portfolio into what I call what's working sectors. So I still not only help financial advisors understand the markets, I do webinars and personal consultations, but I also supply them, I call them tactical relative strength sector rotation models. And that's about it. I'll stop there. Thanks.
Thanks, Dave. I would love to hear about the thesis that you wrote for your CA paper. It's something that I love discussing with other fellow technicians. So let's connect after the mentoring session if you have time. Now jumping right into my introduction. So hello, everyone. I am Kavita Agrawal. I started pursuing CMT straight out of high school. So I started in the year 2012, or was it 2013? I finished all three levels, 2013 for sure, because I finished all three levels by 2015. And I am one of the youngest people to have ever finished all three levels of the CMT exam in the world, as per for the governor of the CMT Association. Don't quote me on that if that's wrong, but if it's right, go ahead. Anyway, so I couple of years back, I founded my own company, EX Invest, which is centered around helping retail traders make better bets in the stock market with respect to swing trading. I also create a lot of technical analysis videos on my YouTube channel. If anybody is interested in learning the practical side of things, go ahead and watch those videos. It might help you out. So that's it about me. Over to you, Siddharth. Siddharth, you're on mute.
Okay, sorry. So I'm Siddharth Shankar, and currently I'm pursuing my MBA in finance from KJ Sumaya Institute of Management, Mumbai. And my background is a bit different. I am from engineering background. I have done my mechanical engineering from KIT University, Bhubaneswar. And after that, I thought to change my prospects background to move into a new arena, that is finance, and it's quite interesting. And also I love the technical concepts, and that's why I participated in CMT, and that's end of it nicely. Thanks. I think I'm done.
Sharvi, do you want to introduce yourself?
Yeah, sure. Hello, everyone. Am I audible?
Yes, loud and clear.
Yes, you are.
Okay, so hello, everyone. My name is Sharvari Pitke. I'm currently pursuing MBA. I'm in second year MBA Finance. I'm in KJ Sumaya Institute of Management, Mumbai. My background is in engineering, but in my third or fourth year of engineering, I started developing interest in finance. So side by side, I started to learn about fundamental and technical analysis about equities. Since then, I'm trying to invest in virtual portfolios, and sometimes I continuously try to learn about new things, like how to do fundamental analysis, how to do technical analysis. So I think CMT is a very good platform, and it has been very helpful for me to build my virtual portfolio and check my strategies.
Awesome, Shavi. Guys, sorry, I joined in a little late. Shavi, Siddharth, so good to see you on the call. Kavita, Dave, so good to see you all again. Thank you for joining us today. Guys, I cannot emphasize enough how great hands these two are. The mentoring session. If I'm not sure if you've seen the past videos, but if you heard Dave speak, if you heard Kavita speak, I promise you're in extremely good hands. So make the most of this opportunity to ask them questions about not just the investment challenge, but things that you want to know about, let's say, careers, technical analysis, markets in general. We refrain from talking about specific trade ideas, but you can ask them about strategies. And I'm going to stop talking now. You have about another 50 minutes, so make the most of it. I'm going to hang around on the backside of the stage, but in case y'all need me, I'm just around.
How are you, Keza? It was really good to see you. All right, so Sharvari and Siddharth, firstly, congratulations on being the winners at the challenge. It's not an easy feat, and I know for a fact there are some people who participate in the challenge who have really management under them to just participate, for fun. So it's great that you guys have come out on the top. And how's been your journey? So Siddharth and Sharvari, whoever wants to take first, like, what's your strategy and how are you doing it? And if there are any roadblocks that you've been experiencing, this would be a great time to face them.
Hi, it was an amazing experience, and first of all, thank you so much for being for mentoring us. We are so blessed to have such a great expertise. to mentor us. So far, I have one main question that I was like shortlisting the companies for in which company to should I go with for in detail analysis. So my question is, should I shortlist some 5 6 companies and watch them regularly, or if we have 500 companies to select from, right? Should I pick should I constantly change the companies, like which company is in trend or which company is in news, and pick that company and do the analysis? So my question is that.
Dave, do you want to go
Okay.
for it?
Oh, yeah. I just for a clarifying question, can you tell me what your strategy was as you approached your evaluation for those, and then maybe we can help with some of those questions.
So far, I have been watching some specific 5 6 companies only, and I have been watching their charts regularly. But my question is, should I change the strategy and focus on the companies which are on the news currently, so that I can better pick the momentum?
Well, a follow-up question I have is, when you look at that subset of companies, what are you using for criteria to evaluate it?
So I have been using Bollinger Bands, exponential moving averages, RSI, and MACD, whichever I feel is relevant there.
And what time frame are you looking at?
1 week's time frame, and I'm using candle of 1 day.
Daily charts.
Yeah.
Okay, and then is the premise is you're in your time horizon's like a period of weeks, right? The challenge is
Yeah.
only like, I don't know, period of weeks.
8 weeks.
Yeah. So when you look at your goal, and for the competition, it's basically to maximize your percent gains, I guess, right? And so you only have a subset of like 8 weeks or whatever it is, short time. So you would adjust your one way to do it is you can adjust your time horizon based on that shorter term. And if you were going to adjust your time horizon based on that shorter term, then it does make sense that you could change your positions based on the criteria you are selecting. So say, for example, if you have your Bollinger Band trigger and to buy and to sell, if your 5 or 6 tickers are either in, you're above it to trigger a buy, you would be in. If they're below, then you would change and look for another type of opportunity. But when you think about your strategy, a lot of times I found helpful is you break it into a process, and you would come up with some sort of screening process based on your whatever you want to do, Bollinger Bands, RSI, whatever the tech indicator is. And you have your screening. And so you should monitor that probably on a shorter term basis. So maybe daily if you want, or weekly. And then you come up with your strategy where it's all a big plan, right? So you have to have a plan in order to be successful. And that takes the subjectivity out of it, at least out of it in your head, and it makes it more objective. And so a plan would be whatever rule you set. If it meets that rule, then you do this. And if it meets this other rule, say like a buy rule, you buy, or sell rule, you sell. But you got to stick to that plan. So the whole point is you come up with a plan for your screening and scanning, and then your rules for buying and selling. And then you would monitor that. And since it's such, since it's such a short-term basis, you probably monitor it more frequently. In the real world, you probably don't change tickers that quick, but for this exercise, you could. Like, so when I say to change them that quick, a lot of my portfolios, I hold tickers for a number of months or longer, but they're longer term. But for this exercise, since it's a short time frame, you could change them daily or whatever your triggers are. As part of your scanning mechanism and screening, you also have to figure on your frequency of your time horizon for your charts. So you use daily charts and you monitor them whenever. But if it's a short-term time frame, you could go to hourly charts. You could try that, or you could try something a little bit even smaller than daily in order to get maybe a different type of flow. So I set it off. I hope that helps. Kavita, any comments?
Yeah, I totally agree with what Dave said here, Sharvi, that you should look at a shorter time frame, because your time horizon is just 8 weeks. So if you're going to look at the daily time frame, you might have to just wait a lot longer for a confirmation if you find a profitable setup. And by the time the confirmation comes, even if it's a great setup, there might not be any more time to let that setup play out. So firstly, it does not matter which indicators you use. You said you're using Bollinger Bands, RSI, or some EMAs, right? You can use the same thing, but look at a shorter time frame. They suggested hourly. You can also look at one time frame lower, which would be, say, 15 minutes or a 30-minute time frame, and one more time frame higher, and look for clusters of evidences, or what I like to call eclipsing. Basically, make sure that one time frame lower and one time frame higher are giving you at least a similar confirmation that your primary time frame of trading is given you. Does that make sense?
Okay, got it. Yes.
Yeah.
Thank you,
and
sir. Thank you, ma'am.
One more question that you asked about tickers, whether you should rotate them very often. See, for the 8-week challenge, that may be a good time being aggressive, in the sense, like, keep an eye out on a shorter time frame on more tickers than just 5 for more trading opportunities. But in the real world, it would be very prudent for a trader to stick to a certain set of stocks and keep rotating them, keep going, like moving your capital through sectors or different tickers as the market rotation, sector rotations in the market.
Okay, sure, ma'am.
Okay. All right, Siddharth, I think you're up if you have a question noted down.
Okay, so I have made investment in a technical company, a technology company, that is Accenture. So it's majorly a US-based company. So while investing, I was thinking, I have also done analysis like the technical part like MACD, RSI, or a moving average. But I want to know that it's not only the technical analysis, but it's the global market scenario and other factors that also affect the stocks and its price. So how much weightage should we give to the technical analysis, and how much weightage should we give to the other factors also while buying a stocks or investing in it? That's...
Yeah. So on that front, I'll again on your time horizon. See, you have to understand that firstly, whatever news you're seeing, whatever piece of information you're getting to know either by earnings or news items, they are dated. In the sense, the event has already happened in the past and you're only getting it to know about it now. So if you want to do very short-term trading, which could be, I'm not going to talk about intraday because I don't think that's a very good practice. But say, even if you want to do swing trading, usually what happens, by the time the news flashes on TV or popular channels, the people who had the information beforehand, they start unloading their positions. So if you want to do short-term trading, then reactionary trading will not be a good alternative. Technical, on the other hand, the whole foundation of technicals is that price factors all information. every information that is out there worth knowing has been factored into the price. So a lot of times you'll see there's a huge surge in the volumes of any stock, but the news about why that surge might have happened comes nearly 2 weeks later. Then there's a big change of hands, or for whatever reason some big institutions started buying some stock, or unless there is of course a disclaimer or report about it or disclosure about it, right? So if you're doing short term trading, then reacting to news would not be a very good strategy for you. Then again, if you want to do long term investing, right? So even for long term investing, what we call breaking news will not help you in picking stocks, because whatever comes on the breaking news is usually more for I don't know, popularity sake, may not be very high quality news. Usually, in my experience, what I found that the pieces of news which are actually worthy of putting capital behind are usually tucked away in some corner of some business website, or if I'm reading a business newspaper, it will be in like a tiny box somewhere just hidden in the pages. And investing on the basis of something like that makes a lot of money, right? But for the purpose of this competition, I think you should stick to using technical analysis more than news based trading. That's my opinion. Over to you, Dave.
I fully agree with that. I think the premise of technical analysis, Kavita said it, is that everything, all the news is baked into the price. And so when I first started out, I never even paid attention to the news, because I was finding out there were reasons. Well, I was finding out when a price chart would surge based on volume or break out a pattern. It always seemed like the media would have a reason for that. It would be like, so say oil breaks out higher, they'd be like, well, supply cuts, but it's just whatever. I mean, you can always find news to meet what's happening in the chart. And it's absolutely true that news might just be old. And the big players are probably already out when that happens. So what I would suggest is don't pay attention to the news, and just go back based on your analysis. And so you have your strategy, you have your plan, and based on that, you should just follow what you think and what your analysis is dictating versus what some talking head on the media channel would be saying. So that's my experience.
Yeah, I mean, news is, after all, is just one man's opinion against another. A lot goes into how a sentence is being structured, how certain subjects are being portrayed in a single form, in the formation of every single sentence is that's been told on the news can impact your objectivity. So go with hard facts, go with what you're seeing only on the charts. As far as news is concerned, I've been full-time trading for the last 3 years, and I've been trading in general for the last 10 years. And my life quality has really improved since I stopped following news actively. Less work to do. Yeah.
Thank you so much.
Just to a follow-up question, like this happens mostly when I use a moving average indicator or Bollinger Bands. So I see a positive signal to buy the stock, but I don't have confirmation from basis of volumetric analysis. So should I go proceed with that trade even when the volumes are not that much high?
Wonderful question, Sharvi. So, whenever you participate in a trade setup, okay, you have to let the trade setup prove to you that it is worthy of your capital. In this case, your virtual capital. Okay. So, when I do analysis, there may be 8 to 10 things that I may look at. And of course, not all 8 to 10 things are going to give me confirmation. For example, I have a certain way of drawing trend lines. I look at the volumes, I look at chart patterns, I look at candlestick patterns, I look at moving averages, RSI, among other things, right? Now, all of those things, and I do all of those this analysis across different time frames. At any point of time, all of them may not give you a useful signal, but in order for a setup to really shine in your eyes, you should make sure that it is giving you a collection of evidences. This phrase I keep repeating, because you should keep looking for multiple reasons why this setup is a good enough setup for your capital. Think of it like this: you have very limited amount of money or capital, right? And there are so many opportunities in the market. You want to put your capital out in the best possible opportunity. Now, for my setups, I prefer to use moving average, volume analysis, and RSI. Sometimes the volume may be very, very meek in a situation where, say, RSI and not moving averages, but RSI, suppose, is giving me very positive indication on 3 time frames. Okay, so RSI saying the same positive story across 3 time frames, in my eyes, is a super strong indication that a positive trend is coming. So even though the volume might be super meek at the point where, say, the price has now started to consolidate after a downtrend, I will still go ahead and make a position in that. How I will let volume play a role would be that if the price starts moving in my direction, when the volume starts catching up with that price move, I will allocate more capital to that position. So, like, one more thing that I will add about capital allocation is that your strategy will differ depending upon the strength of your setup. If it's a very strong setup, right, but you still would like some more confirmations on that, don't allocate the capital in a lump sum, do it in installments. Whereas, suppose you're catching a trend continuation during a big dip, in that situation, go ahead confidently, put your stop loss, allocate as much capital as you can without taking unnecessary risk, and just ride the trend.
I completely agree. In fact, it's funny that we use the same indicators. That's pretty cool. So my point I was going to suggest is very much the same. I would, if you don't have the confirmation that you are looking for like for a full position, just do it in tranches. Do like Kavita said, small position, increase it if it starts to work, and just work that way and keep your risk lower. That's what I would do.
Okay, thank you so much.
And see, you have to have a very strong management of your open positions and your open orders. So a lot of times we we may keep a track of our open positions, but we may not keep a proper track of what orders we have pending in terms of, if you're using bracket orders. So have a system to identify those on your charts as well. I personally like to use white color lines on my charts to mark wherever price levels, wherever I have open orders or bracket orders placed. I like to mark those also on my chart, so that when I look at any particular stock, I know exactly. I also mark my past trades with green and red highlighters, so I know where my entry price has been on the chart, even if it's not integrated with the broker account. I mean, Dave, this may sound surprising to you, but in India, the biggest broker, that is Zura, it's not integrated with the biggest chart services provider, that is TradingView. So traders like us have a big disadvantage there. We have to manually mark everything on the charts, and it's crazy. But it's a very good practice to do that.
Oh, so that's a very good point, and it's so you can manage your plan actually based on a chart, or you can manage your plan as like a separate thing, like a separate Excel spreadsheet or whatnot, or together, right? Use them together. And but the whole point is you have a plan and you are managing to it, and that keeps your risk where you want it to be. You don't want to be doing something that's overly risky where you would, if it goes the wrong way, you would just cut your profits down or lose money. So that's the most important point.
Sure, we will try to implement these suggestions. Thanks a lot.
Okay, Sharvi. Siddharth, do you have anything to ask? You've been quiet.
Yeah, so it's very often I personally feel this difficulty because while investing, I found out that where to make that stop loss order. So, is there any strategy regarding it? How to set up your stop loss order and all in that stock? That's
So that's actually very good question. That's difficult. The whole stop loss
It's a very loaded
criteria is very
question.
tricky, and a lot of times when something stops out, it goes the other way, and it looks like a good buy, and you're already out. So it's very frustrating. Um, that happens to me too a lot. So the trick,
Yeah, it
the
happened to
trick
me
is,
today. So.
oh my goodness, it always happens. The trick is to practice, and you could have or just you could keep a very rigid plan. So a lot of the more shorter term traders will be very tight on their stop losses. And so in my opinion, I don't really like doing the very short term trades because it's a lot of trades and you have to really be on it.
Oh my God. Yeah.
So I think you either have the mentality, if you're very short term and you're down whatever, 3 cents, whatever it is, currency, whatever it is, then you're out. I don't like that way to do it. Or you go with one of your indicators that you've practiced with, and you'll know when to get out. So as an example would be, if you use like a moving average as a stop loss criteria,
yeah,
well, a lot of times when you hit the moving average, it bounces higher, right? So what you would do is, if you've recognized that for a certain either index or ticker, you would put like either a percent below that moving average, whatever, a certain percent number, or like a currency quantity, and then so you would make sure that if it went under, well, this is what I do is if it goes under the moving average and then it retests it, but it can't get back above it. So you go from what used to be support, you break support, you come back up, and now it's resistance, and you can't get above that, then you'd get out. So there's different strategies. For a short-term project like this, if you're trading the 30-minute charts, you would have to watch the patterns, I think, and then you would just go with that. You'd watch for the lower highs or the higher lows, right? And kind of manage it that way. I'm sorry the answer is so loose.
yeah. Thanks.
It is a difficult question. So that firstly, good job asking a really hard question to us. So setting a good stop loss is really an art. You have to make sure firstly you respect every single stop loss that gets triggered. You let it take the hit, take your portfolio. Let your portfolio take the hit. And what is very important in improving your stop loss skills is to always go back and study your last quarters or your last month's trade, because that is how you'll see where you went wrong and where you can improve. With respect to your challenge right now, so one practical advice that I can give you is, when setting stop losses, I look for two things. One is, at what stage of the trend a stock is in. See, a stock can be in 5 different stages of a trend. One is where it's at the base, then it's just coming out of the base, it's in full momentum, it's losing momentum, and then it's stopping out, which is again coming the base. And then the same phases go on the downside, right? Like turning down and then full momentum and down, and then losing the downside momentum. Your stop loss strategy, and I'm only talking about the long side trades here, your stop loss strategy will firstly depend on what stage of the trend a stock is in. If it is in a stage where it is coming out of the base, you will need to use a more liberal stop loss versus when it is in a full swing or a full momentum uptrend. So that's the first thing. So there are already 5 you can say subsets in this first point, or bullets in this first thing that you need to consider. The second thing that you need to consider is, how does a stock interact with the indicators that you're using? Okay, so why I always also recommend people to use few indicators. You don't need to use more than 2 or 3 different indicators in combination with few other tools like volumes and trend lines and maybe Fibonacci ratios. You don't need to use a lot of them, because different stocks have different ways of interacting with these moving averages and these indicators. So what do I mean by that? You will see, say, if you study the 200 EMA on the charts, you will see that some stocks have a tendency of bouncing back from the 200 EMA before even touching it. Some stocks have a tendency of exactly touching the 200 EMA a lot of times and then turning away. Some stocks will have a tendency of just breaching the 200 EMA and then turning away. And then if you're using 4 or 5 different types of moving averages, then your study multiplies that many times. And if you're using 3 different time frames, then your study multiplies that many times more. So even if you're using just 2 indicators, you have to do a very thorough analysis of the entire universe across different time frames for every single stock. This is also why you should always work with a small universe of stocks, because the more you analyze, sure, you may not be able to write an essay on it, but you will develop develop an intuitive sense about how a stock reacts with your different indicators, and that will then help you set good stop losses over time. That being said, never ever use a thumb rule of I'm going to set a 1% stop loss, because you may have a great setup, but using a fixed stop loss like that, it's good for beginners to start with, so that they can at least cultivate the habit of using a stop loss. But once you're beyond that reality of just, because it's very hard for new people to start using stop losses, once you're beyond that difficult stage, you can start working on your stop loss strategy, like improving your stop loss strategy.
Yeah, and I just want to reinforce the point. There's so many good points you just said. Thank you. Keeping a plan and in studying your plan, studying what worked and what didn't work is so important. And it seems like it's a lot of work, but it really isn't. And it only takes maybe a minute or two in a spreadsheet. And then when you have time to reflect on it, it really will help you. And so it's so important, for one, to do a plan, but secondly, to understand where things didn't work or did work, and then understand that. The second really important point was keeping your number of indicators low. You don't need that many indicators. I don't use that many. My key indicator for so many years was the RSI, and I think if you study one indicator and you really learn it, it'll add so much profitability to your trades. And the last thing was that I totally agree. If you trade just a smaller number of tickers or indexes, you'll get to understand their behaviors, and it makes things better, and it'll make your stop losses better. It'll make your breakouts better. And I just think those points were so good. Thank you so much.
Okay, so thank you, Dave and Kavita, for such a great insight.
It's a pleasure to speak to you both. You both are really, really bright, and I hope you guys do really great.
I have a question.
Yeah, I'd be very happy to connect with the two of you. Yeah.
Sorry. I had a question. Do you all, is this your first time doing a virtual trade, or do you trade real time? Both.
So this is my first time. As a part of our curriculum, we have to invest in a virtual platform. So I'm just learning, and I love to learn, and I want to explore more into this domain. That's
I have done such analysis before, but that too was for paper trading or virtual trading, not with real money.
Did you just say that the curriculum has made it compulsory for virtual trading to be participated in by candidates?
So I can jump into that one. So it's a unique thing that their institute has done where the professor has made it a part of their finance course that you have to take part in the investment challenge, and they will be ranked and scored based on the performance in the investment challenge. And this is a trend actually we've seen from a few faculty members who have started bringing in this live project into the classroom, testing candidates on a real-time market strategy perspective. So it's amazing to see that, and it's amazing to see you all perform, win, and be here. So it's no short feat. So congratulations for being here as well, guys.
Thank you.
Thank you so much.
Yeah, I would love to connect with you too. So please reach out to me on LinkedIn.
Yeah, sure, ma'am. We will send you a request.
Sure. That would be our pleasure.
Thank you.
So,
yeah, please reach out everybody to me as well. Thank you.
Yes, sure.
Yeah, sure, Dave.
So guys, do you all have any other questions for our mentors? Because we have a question on the chat as well. So unless you all don't have anything, then I'll take the question from Discord. Siddharth, Sharvari, do you have anything else?
No, I think I'm done.
Yeah, same. I'm also done. We can take
all right.
questions. Yeah.
Perfect. Mentors, we have time for questions from the chat. So let me first share a question from Nikki P. She said, I'm curious on the pyramiding into a position, whether the speakers have a set percentage they follow, that is 20%, 30%, 50% when it starts proving out, or do you adjust it for each position differently? And also in setting protective stops, do you speakers agree with never moving the stop away from the trend after you have already set it? Or do you use something like an ATR multiple for stops? That is a loaded question.
Do you want me to? I'll start. Okay. So the first part of that question, if we break it down, the position sizing, it's a lot of factors that Kavita brought up earlier. So if your charts are like trending or in momentum or the various stages of the trade, you could actually give a higher percent as part of your tranches, or you could just run your plan. Like a lot of folks just run plan where they do 33% 3 times or whatever that is, 100%. But you break it up into set percents that you've already established. So that would just, I would base that on not only the factors of what the chart patterns are suggesting, but you really have to be careful too of what kind of thing you're trading. So if you're trading a stock that might be more volatile, then you have to be a little more careful. And if you're trading a stock, first off, you should trade stocks with pretty low bid-ask spreads. If you have a high bid-ask spread, don't trade it. But that means it moves a lot, right? And so if you're into a stock that moves a lot, then you have to be careful about how you pick your percents. In regards to your stop loss question, my input is if the stock is moving higher and you've already met your price objective, then you could put a trailing stop loss on there, which would adjust from your initial stop loss. And that could be based on however you want to measure that, based on an indicator or whatnot. So it really depends on how the stock is reacting to what your expectations are. But so that's about all I have.
Yeah, thanks, Dave. So I'll answer on this. So tackling the first question first about pyramiding. So if I have a short-term position and if I've identified an opportunity, I usually go with 30% allocations. So I'll make 3 allocations at 30%. One is as soon as I've identified a positive setup, second at the confidence, and then third will be when it starts moving. Now, because I predominantly use RSI, I think RSI really lends me the luxury of, allocating capital before true confirmation comes. So I prefer to do around 30% of that, unless, of course, it's a trend continuation position, in which case, if I'm participating in, say, a dip in a trend, in that case, I'll go with straightforward allocation of 100%. Sometimes it may also be that if a stock is doing really, really well and I have already allocated 100% of my capital, but I have some liquidity, I may go ahead and add a little bit more capital there, like 10 or 20% more of what has already been allocated. That will be in a situation where, say, I have capital sitting and I don't have any other good opportunity in my hand. Whereas if it's a long-term stock and I am looking to make positions there, I would go with 20% allocations, because usually in my long-term positions, the stop loss is obviously a lot bigger, because, we are trying to catch the beginning of a much, much bigger trend in the situation. And it'd be very if we try to call a bottom in a stock which has, say, corrected nearly 30, 40, 50% in the last, say 3-4 months or even 3 years, right? So we have to keep a much more generous stop loss in that situation. So there I prefer to allocate maybe 15 or 20%, much smaller packets. And even in my long-term positions, I prefer to set my stop losses, because my capital is very dear to me. And no matter how good the company is, fundamentally, I am not going to let it take my capital away from me, right? So answering the second question now, in setting protective stop loss, so yes, I have a rule of never ever moving my stop losses. Even, it took a lot of practice, and a lot of it was very painstaking initially. But even if I'm looking at a price and I know the stop loss is going to get triggered, I will not remove it. Even if, say, like Dave pointed out earlier, that sometimes a stop loss may be triggered and the stock may still be a good opportunity, I am okay re-entering it, but I will not move or cancel that stop loss, because that is a very bad practice and it cultivates bad habits in trading.
I have a question for our mentors today. Individually, separate questions. So Dave, I heard you speak about the fact that you had strategies, or you take positions sometimes months out on a line, right? Especially for the audience members today who are comprised of CMT candidates as well as students from academic partner program who are actually exploring this world in the first time. There is this large misconception that technical analysis is for short-term trading, and we're working really hard to dissipate that, and you are an example of this. There is an element of behavioral bias that comes in when you're looking at forward-looking positions 8 months, 12 months, a couple of years down the line. So Dave, what's your process? Because, markets adapt, markets evolve, news comes out, things change. How do you, what is your thought process in that position that you've taken? Maybe say something that your horizon is 8 months or 12 months down the line.
Yeah, thanks. I appreciate that question. So let's see. A lot of help that I help a lot of financial advisors, and financial advisors aren't allowed to trade quickly because, of course, you're trying to keep your clients happy, don't let them be alarmed, cut the churn, whatever, right? So I've been working longer term models for a number of years. And so when you think about longer term, you have to adjust how you analyze the price. And it's the way you adjust it. So say, for example, you're looking out a year. I call anything over a year long term. That's just the way I think. I use monthly charts. And so I use indicators based on monthly charts. And I typically only it's very simple. I use a monthly chart and I use the monthly RSI 14. And what I do is I look for trend. So you have to, I use a moving average too. So I use a monthly chart with a 10-month moving average, which is equivalent to a 200-day moving average. So it's a significant average. Then I use the RSI 14. And what you do is anything, I keep my tickers to the S&P 500. So they're large cap. Okay. So they're like more secure stocks, right? And so what you do is you base your scanning on what is trending, so what's above that moving average, and what is above a certain RSI 14 number, and then that's what you would invest in. And then based on my back testing, a lot of the positions, and you can do indexes, you can do industry groups, you can do sectors, you can do tickers, you can do anything you want to do. But based on my experiences, when you look at the monthly charts, they tend to persist. And so you can get trades that don't turn for like a number of months, like even over a year. And that's how I managed that. And what I did is, it took a long time to figure out the strategy because I had to do so much back testing. But after I figured out what works from the recipe perspective of indicators, I've come up with a model, and the model works. And so I just follow the model, and I do my scanning, I do my buying, and I do my selling, all based on what the model says, based on longer term charts. And it works. And you don't have to do, it takes the day-to-day pain of watching the volatility or the cycle, the shorter term cycles out of it. So you don't have to think about it. You can just basically set and forget. And believe me, the mentality is that set and forget's not that great, but it actually can be. And so that's how I do it. You just extend the time horizon of your charts.
Fair, Dave. Thank you so much. Kavita, this I think I asked you in the last session as well. It's adapted a little more, and something you said right now, right? The price discounts everything, especially when you look at these news articles that come out. Having said that, a large element of behavioral bias still plays out. I'll give an example, personal example. You've heard of these two companies, NVIDIA and Microsoft, who are heavily investing in AI, technological developments, and so on. And throughout the process, everyone believes that these are great long-term companies. Now, even though the chart may not speak, and I'm not speaking of just these two companies, but even though the chart may not speak about this, there is some kind of a behavioral bias that, yes, these are companies and this is why we should invest. Which brings into question the opportunity loss, whether I should time my entry-exit strategy within these companies itself, should I deploy my capital somewhere else, and then when the trend starts moving for these companies, should I invest? How do you play out a scenario like this where your behavioral biases come in, news comes in, it's an amalgamation of all the factors?
Yeah, see, guys, what you're referring to with respect to the evolution of AI, that is actually not a news article. That's a change in, you can say, the landscape, So a news article is something which comes out today, but, is outdated tomorrow. But AI is something that people have been talking about for like nearly a year now. And it's still very, very new. We still don't know where it's going to take humanity on the whole. So it's a much broader shift. So reacting to something groundbreaking like that and making an investment decision on the basis of that, I would say is very, like, it's common sense, right? And looking at an example closer home, say the launch of the Chandrayaan 3, right? Sending that to the moon. India now, it has established itself in the aerospace arena. That is not a piece of news. That's a landscape shift. That's an opportunity. That's a whole new reality coming into existence. So when we talk about not reacting to news, it would be more in the lines of, say, some big C-suite executive suddenly overnight resigned from a company. That's a piece of news because, that gets old like in a week. People will start talking about something else very soon. And sure, the prices may take a knee-jerk. Prices may give a knee-jerk reaction, but then we've always seen that, it kind of makes up for itself pretty easily. So that would, and as far as the behavioral biases go, these behavioral biases are more of a difference in opinion, and it's a very healthy part of the market. So that is something that I would not give a lot of attention to. But again, if you are somebody who wishes to or already does use technical analysis for your investment decisions, I would suggest don't let these external factors affect you, because may it be a big financial scam unfolding, may it be a big opportunity unfolding. See, there is somebody way more ahead of you in terms of the information curve, in terms of financial prowess, in terms of intelligence, who has this information, has reacted to this information that's captured in your charts. So if you want to make good investment decisions, just have very, very focused view of believing what you're seeing in the charts. You don't have to listen to anything else. Your chart tells you everything you need to know.
So Dev, Kavita, what I've taken back from both your conversations, a common point is that trust your systems, right? Trust your processes, have a laser focus, they work, you are comfortable with a particular level. And I think that's one of the messages we try to give the larger audience as well, that it's not a gamble. There is a system, there is a process, there is a methodology, and we believe in it. And that's how we invest in the markets. On that note, guys, we're just 5 minutes away from closure. Dev, Kavita, thank you so much for joining us today. I do believe that a few of our audience members will be connecting with you over LinkedIn, over Discord, because I believe there will be follow-up queries which will come there. But thank you once again. Sharvari, Siddharth, thank you for joining us. I hope you had an insightful session, and I look forward to seeing you all participate and continue to win in the future editions as well.
Thanks a lot for this wonderful opportunity.
Our pleasure, guys. Thank you so much. Take care. Have a lovely evening. Have a
Thank
lovely
you.
day.
Thank you, Keza.
Bye-bye.
It was really nice seeing you.
My pleasure, Dada. See you.